All right. Hi everyone. This is I believe, the first session in finance. Um, First presentation is going to be by Humberto Gallucci Neto, commercial banks, venture capital, and conflict of interest. Then Marcelo Fernandez is going to be presenting betting unconditional alphas, and then I'll close presenting automation adoption, financial regulation, evidence for stock trading frameworks. All right, so Humberto, take it away. You have 20, 25 minutes to present, and then we're going to open for Q&A.
Thank you, Pedro. So let's start. Okay, so our paper is about commercial banks, venture capital, and conflicts of interest. It's quite an unusual topic when we work with commercial banks and venture capital. So our main motivation in this topic and in conflicts of interest is to study how does the interpretation of Section 20 from Glass-Steagall Act affect venture capital investments by banks. So before 1989, we had few banks that could underwrite corporate securities. Not all banks could do that. Before that, you should go to the Fed and got an authorization. So that's the main point of the paper. So some banks could have this kind of authorization, and some banks couldn't have. Commercial banks made more than 700 billions of investments in private equity and venture capital. It's something about 30% of the whole industry. So they are very big investors. And we had few papers in venture capital and commercial banks. So we think that's interesting because corporate venture capital, for example, that had almost the same kind of investments and do almost the same. We had much more papers about corporate venture capital and not so many papers about commercial banks. Articles using commercial banks and venture capital, they usually compares commercial banks and investment banks. And like Manjupuri, for example, she did this. She made a comparison between commercial banks and investment banks underwriting corporate bonds. They usually study the conflict of interest between laws and underwriter activity, but that's not what we are doing in this paper. Glass-Steagall Act is from 1933. It prohibits depository institutions from being underwriters. So if you had a commercial bank, you couldn't underwrite bonds or underwrite equity. So it was prohibited in 1933. After that, there is a clause. There we have the Section 20 of the Glass-Steagall Act that makes a link between banks and security firms and investment banks. In this section, what we have is that banks could not have an investment bank arm if this investment bank arm is mainly engaged in underwriting. So that's what we have in the Section 20. So, well, if the bank is not mainly engaged in underwriting, maybe he could do some kind of underwriting. And this is the reinterpretation in 1987. So more than 50 years after Glass-Steagall Act, we had this kind of reinterpretation. So in 1987, commercial banks could had an investment bank arm that we will call this kind of investment bank arm as Section 20. So they could underwrite municipal and commercial papers and things like that, but they could not underwrite corporate bonds or equity. So and more, and they only could underwrite municipal bonds and commercial papers if they were only 5% of the gross revenue of the bank. So just a little bit of underwriting in 1987. After that, those banks had the authorization for underwriting corporate bonds in 1989 and equity in 1990. So they could do 10% of the gross revenue of the bank underwriting corporate securities. And this was an innovation in the sector. After that, in 1996, those banks could do 25% of their gross revenue by corporate underwriting corporate securities. So they were doing this kind of reinterpretation over time. So they were changing how much those banks could do. So they were changing over time. What we are doing in this paper is that, well, we're exploring this change in some banks could do underwriting, some banks could not. So we have two kinds of commercial banks. Some banks had a Section 20 subsidiary. It's like an investment bank arm of those banks. And the commercial banks were investing in venture capital before that. So we had some banks investing in venture capital since 1970. So they know how to do venture capital, but they could not underwrite those securities, those companies, or underwrite the IPO of those companies. So so it's a good change for them. What we find is that those banks that are allowed to do underwriting, they had more divestments, more exits by IPO and M&As. So they were investing after 1989. They were investing more in more mature companies. They started investing more, co-investing more. So they were investing less alone. And they started to invest closer to the bank, less in early stage. So they started to investing in more mature companies and investing more by IPO and M&A. So our data is from 2001, and we are using the data between 1981 and 1998. That's because in 1999, we had the Financial Services Modernization Act. So all barriers were removed in the industry. So commercial banks could have an investment arm, could do whatever. So Glass-Steagall Act wasn't in charge at this point. So this Financial Services Modernization Act made all banks equal and everybody could do the same. So that's why we dropped the data after 1999. We had to do the manual identification of commercial banks in the database. So it was quite fuzzy and difficult. And our analysis unit is venture deal. So it's the link between a fund and a company. In venture capital, we have two ways to do our papers, our investigation. One is using funds. So the measure, the unit of analysis is funds. And the other one is this kind of analysis that is eventually due. So if a fund invests 2 or 3 times in the same company, we only count as one investment. So we just keep the first investment in the company. So in venture capital, it's the normal, the most common thing is to invest in rounds. So 2 or 3 rounds in the same company. We just count only one time. So if a fund and a company had more rounds together, we just count one of them. So that's it. And what we had in our data is that we kept only funds, only banks that had investments and before 1989 and after 1989. So we had something like 25 banks that had a Section 20 subsidiary, but only 7 made investments in venture capital before and after 1989. So what we had is that those 7 banks that made a Section 20 subsidiary made near 600 investments before 1989 and near 200 investments after 1989. We did one match using those variables of history or reputation, like amount invested before 1989, a number of investments, age of the first investments in the venture capital industry by the bank. And we did 2 different matches. We used the whole data, so we had 14 banks that were investing in venture capital but didn't have a Section 20 subsidiary, and we compare with independent venture capital firms and investment banks that were investing in venture capital during the same period. So what we had is that those banks had a proportion of IPOs of 26%. It's almost the same as independent venture capital firms, less than investment banks. So as we can see, we have few difference between Section 20 banks and other banks. In our match, our first match, for example, had a difference in proportion of success, for example, while the second match is the best one because we don't have difference before 1989 in those samples. But while independent and investment banks, they were a little bit different. So we didn't made a match between independent and investment banks with Section 20 banks because they were quite different. So we are keeping the whole sample for investment and for independent and investment banks. So our methodology, it's quite simple. What we are doing is that, well, we are trying to explore if the number of success, the proportion of success or IPO success for us is a positive outcome in the exit of the company. So if a company made an exit from the portfolio by an M&A or IPO is a success, while IPO it's more clear. The other kind of outcome is a failure. So if a company goes bankruptcy, it's a failure. So that's the other side. What we are doing is a simple diff and diff analysis. So we are interested in what happened with those investments made by Section 20 subsidiaries after 1989. We did two kinds of analysis. So this is the first model. This is the model for success and IPO, and then we will take a look in other variables. So we don't use we use almost the same model with some kind of difference. So what we had is that, well, before the reinterpretation and after the reinterpretation, Section 20 banks had the same proportion of IPOs, while the probability of success is 15% higher. So it was 16%, 65% before 1989, and it was 80% after that. This result, the first result for IPO, it's quite interesting because other sectors, other investors like independent venture capital firms, they had less IPOs after 1989, while investment banks had a little bit less, and other commercial banks had much less proportion of IPOs in their exits. When we take a look in the probability of success, it's the same. So they had more success after 1989. So it looks like they were acting different. If you take a look in the other commercial banks without Section 20 subsidiary, they had the same probability of success, and Section 20 had more. So this is very interesting. And after that, after we did this kind of regression, well, we thought, what else we can learn about them? So maybe they are changing the way they are investing, and that's what we saw in our data. One thing that they changed over time is that Section 20 subsidiaries had less investments in round one. So round one is the first investment made by this is the first investment that a company received from a venture capital firm. So they were investing less in the first round. The main point here is that they are investing in later rounds in more mature companies. So 66% of Section 20 investments in venture capital companies were made in later rounds after 1989. So it's very different on what happened in the rest of the industry. For example, independent venture capital firms had almost the same before and after. Commercial banks without Section 20 subsidiaries had almost the same, while the only one that is reducing the number of investments in round one companies is investment banks. More than that is that they are investing alone. So the proportion of investments that they made alone in the first round. So they are the ones looking for the investments, or they are the only ones that are investing in the first round. It's almost the same before and after, while in other investors are doing the opposite. So they were doing more investments alone, especially independent venture capital or are investment banks. So this is one change that we think that could lead more divestments by M&A and IPOs. What else? So they were investing more in the first round. So at the time of the entry, they started investing 10% more, while other investors were investing less. So just to remember, the 90s, it was more investing in technology companies, and so the value, the dollar value that you're investing less is less money, while Section 20 were investing more. Probably they are not investing in technology companies, they're investing in more mature companies. There are also making something like 40% of the round of the investment. So it's almost the same as the whole industry. So they are financing more of the round during this period. What else? So they made less investments in early stage, just 5% less. It's almost the same for everybody. And there is one point that is very interesting. Distance is very important in venture capital investments, because you need to monitor your investments. And before 1989, Section 20 banks were investing very far away from banks, so they were not doing any kind of monitoration of those firms. When we compare with other investors, we can see that other investors are investing a little bit far away from what they had before 1989. So probably the Section 20 banks were investing closer, so they could monitor a little bit more, or they were investing in companies that they know more because they had relationship, for example. And the last point is that they were investing less in California and in Massachusetts in venture capital. We call this as the venture capital cluster. So the main companies that are receiving venture capital investments are in California and in Massachusetts. So they were investing less, probably because those banks, most of them were not in California and in Massachusetts. So we had a lot of banks in Chicago, in Texas, for example. So they were investing closer. So they are not investing in California and Massachusetts. So what else? This is an important point. Section 20 banks had more IPOs and M&As after 1989. Where is the conflict of interest? So isn't it better for the investor, the limited partner that is investing in those banks? Probably not, because if they are investing in more mature companies in later rounds, they are investing more, they are paying more to enter in those mature companies, and the return will be smaller. So that's what's happening, for example, right now in Airbnb IPO. So those companies that made investments 15 years ago, 10 years ago, they are fine. They'll have a really nice internal rate of return. But those companies that made investments in Airbnb in the last 5 years, they're not going to profit a lot, or they are going to profit very little in the IPO. So probably they were in banks with Section 20 subsidiaries made more investments with success. However, the profits probably is a little bit slower, but slower not, it's lower. Will be probably the profit will be lower, and so it's not the best. Well, what's next? So we should understand if this kind of equity participation turning into a cross sale. So if they are selling more loans for those companies, M&A advisory, or they are underwriting those securities, that's something that we should do in the next month. And there is a very important point here, is that not every bank had a Section 20 subsidiary at the same point. So we had some banks that had the authorization in 1993, for example, and we had to drop this data. So it would be nice to implement a multiple difference and difference, so we could have more data to analyze. So that's it. Thank you.
All right, Humberto, thank you so much for this great presentation. We still have around 4 or 5 minutes for questions from the audience. So in case you have any questions, you can just go ahead and unmute yourself and ask them loud, or else you can just type in the chat and I'm gonna read to Humberto as well.
Yeah, that's okay. No questions. Really nice article without any problems. So that's okay. Thank you.
Okay. Anybody? Maybe someone is just typing in. Okay. If anything, at the end, if we have more time left for Q&A, then if you would like to come back to Humberto's paper, we can do that as well. So if nobody has any questions, I will pass it to Marcelo, who will be presenting his paper with co-authors, Betting on Conditional Alphas. Marcelo, take it away.
Okay, thank you very much, Pedro. So let me start my timer here. Start. Okay, it's a great pleasure to be here to present a paper with Valentina Corradi, Walter de Stazo, and Asger Lund. I've been checking my slides in yesterday when I arrived home to see whether everything was okay, and then I realized that the first time I presented this paper was in 2012. So a long time ago. So it's 8 years of being working on it, and now it's a huge, much larger and broader application that we had before. So without further ado, let me go to the paper and try to pass the message right away. So the motivation is a very old motivation in finance and asset pricing, which is that the conditional CAPM does not describe well equity markets. Don't get me wrong, the unconditional CAPM works pretty well when you look at different asset classes. So if you put together equity markets, bonds, it kind of explains pretty well why bonds earn much lower expected returns than equity markets. But when you look in one specific asset class, could be in fixed income or could be in equity markets, then it doesn't work very well. What do I mean by doesn't working very well is that the alpha in the KPM, which should be equal to 0, it's non-zero. Essentially, that's the problem, right? Obviously, that doesn't mean much, because once you take the formulation of the KPM, the original formulation, it's something that should work conditionally, right, for every filtration and time. So the absence of pricing error does not suffice to ensure that alpha is equal to 0 when you run an unconditional KPM. Why is that? Because the beta, the beta could be correlated with market volatility or, with risk premium. And if that's the case, if you run an unconditional KPM instead of a conditional KPM, in the end of the day, what you're going to get is a non-zero alpha, which is going to reflect this correlation. Okay, so obviously there are well-known market anomalies that people have been working since the 90s, since from French. But the one I want to talk about today is the betting against the beta. Okay, so there's a significant premium for betting against beta, or betting against alpha. It's exactly the same thing in some sense, given that market betas display mean reversion and also some co-movement with market volatility and risk premium. So I think the most famous paper about that is Frassini and Patterson in GFE 2014. But there's a more recent paper by Horenstein, which instead of looking at betting against the unconditional beta, looks at betting against unconditional alpha, and shows that's essentially the same issue. So what's the usual fix for the unconditional KPM is essentially to make both alpha and beta affine on stock characteristics, right? So I think Wayne Ferguson is the guy who has developed and did this literature, especially at what concerns the alpha. Normally there are a lot of papers doing affine betas, but not so many doing affine alphas. And I think Wayne Ferguson is the guy who started doing that. So you essentially say that alpha and betas are functions of stock characteristics, interest rates or spreads, and any sort of business cycle indicators. And then that's very easy, because if these are fine, you end up still with an affine a linear model, right? So instead of having only the risk factors, in the case of KPM, there is only one factor, which is the market portfolio, the excess return on the market portfolio. You're going to have not only that, but also the interactions between the excess return on market portfolio and those instruments here, stock characteristics, interest rates, and spreads. Okay, so it's very easy to estimate because it's still OLS. It's very easy to interpret, or perhaps not, depends on identification issues, because you can always, it's always difficult to tell whether you have an affine alpha or one of these instruments is indeed a risk factor and not something that is changing the alpha over time. The fit is much better. So if you take the intercept of this conditional KPM based on affine alphas and betas, the intercept, so the alpha part, which does not change over time, is at least half of the unconditional KPM. So the fit is really, really bad, much better. Though we know that it's actually incorrect to do affine alphas and affine betas without linking them. There's a beautiful paper by Patrick Gagliardini, Elisa Ossola, and Olivier Scaillet in Econometria 2017, showing that alphas and betas should vary over time together, and there's a relationship between them if we do not want to have arbitrage. Anyway, so the stylized facts of this literature is that market betas indeed vary over time, and a lot. Pricing errors are smaller on average, at least half of what they were with unconditional KPM, and that this non-zero pricing errors also vary over time. So literature is huge, right? There are many papers in this literature. I think Shanken in Journal of Econometrics 1990 is a key reference here, because he's the first guy taking into account the estimation error in the alphas and betas in the second pass when they do the cross-sectional regression. But you have other papers that go in this direction. Jagannathan and Wang, Christopherson, Ferguson and Glassman, Letao and Ludvigson, Wang, and Adrian and Franzoni in 2009. Anyway, so questions that we're interested in this paper, there are two kinds of questions, questions about methods and questions about the conditional alphas, right? So the first thing about methods, I'm a non-parametric guy. Valentina Corradi is a non-parametric lady as well. So it's natural that we are going to ask whether the affine specification is flexible enough or not, right? So you know, it's always a risk if you have a fully parameterized specification, such as the affine specification, a linear model for the alphas and for the betas. It begs the question whether this is flexible enough or not, because perhaps you can have some nonlinear effects as well. So that's one. And two is, what is the optimal sampling frequency to analyze this thing? Should we look at daily data? Should we look at intra-daily data? Should we look at monthly data? And that's a very difficult question. Perhaps it doesn't seem so, but there is a big issue here, because for betas, what you need actually for any measure, it doesn't need to be betas, but any measure of risk or second moments, what you need is lots of data. It doesn't matter, you know, like what is the time span, you just need lots and lots of data. So it essentially calls for high frequency data. Whereas for alpha, what you need is time span, right? So you need 100 years of data. You don't, that's what is cool, you know, to estimate the alpha. Not exactly how many data points you have. Going to the high frequency is not going to help you to estimate alpha in some sense, right? So these are difficult questions that we try to solve here. And then obviously there are questions about conditional alphas. Once you estimate these conditional alphas, we want to understand what are the main determinants, how persistent they are, because if they are persistent and predictable, perhaps we can build a trading strategy to profit on them. And we would like to understand whether this trading strategy would be portable or not, in the sense that whether it would be profitable to trade them. If they are not, if it's not profitable to trade all these pricing errors, these obviously identify some limits to arbitrage. So the focus here is going to be on the pricing errors. It's not about the risk premium, and most of these papers in the literature are about the risk premium, and here is essentially about pricing errors. We don't want to test asset pricing models like in Shanken and other papers. What we want is to identify, estimate these pricing errors, and try to profit on them, or to see whether it's profitable or not, to build a trading strategy on them. So we want to get rid of one problem, which is the conditional betas. So we don't want to specify a model for the conditional betas, so we're going to be fully non-parametric here. We make no attempt to model the conditional betas. Instead, we take a realized approach. So what is the realized approach? We're going to use very high frequency data. Remember that I told you that if you want to estimate second moment quantities, that what you really need is lots of data. So we go to the high frequency, to the ultra high frequency, to estimate these betas. Okay, but we're estimating daily betas based on very high frequency data. And once we get rid of the betas, because you know that's what the realized beta is going to give you, a measure of the conditional beta on that day. It doesn't matter what is the driving process of this conditional beta, then we can estimate the conditional alphas. So it's a fully non-parametric method to back out this conditional betas. So the empirical strategy, it's very simple, right? So we're going to have stock prices evolving continuous time, because we need that for the realized beta approach. But we're going to have state variables that move in discrete time. So the conditional alphas and the conditional betas are based on this filtration in discrete time and not in continuous time. We're essentially saying that the states of the economy are moving essentially in discrete time instead of in continuous time as the stock price process. And there are a bunch of papers that justify this kind of approach. So we're going to assume that both the drift and the diffusion components are measurable functions of the state variables, and hence constant over a shorter interval of time. Here we're going to take it daily, but we could have taken it weekly or monthly or whatever, right? You know, that the approach is generally enough for that. We're going to assume here a diffusion process for stock price, but again, we could include jumps. It wouldn't change much the approach, the econometric framework. Okay, so the identification is very simple. We estimate the realized beta, right? And then we adjust for risk. How do we adjust for risk? Essentially, you just take your return, and extract that. You subtract from your excess return the beta times the excess return on the market portfolio. Once you do that, the return of that asset is risk adjusted. So the only thing that should remain is conditional alpha and then innovation, right? But the conditional alpha is obviously measurable on T, whereas the innovation has to have a mean equal to 0. Moreover, the innovations are also independent of the conditioning state variables, right? We know that, that's the orthogonality condition for them. So to back out the pricing errors, essentially what you have to do is just to take the conditional expectation of the risk-adjusted return. That should give you the conditional alpha, because we know that innovations are orthogonal to this to the state variables. So that's essentially what we do, and it's not very different from what people. It's just a different angle of what people have been doing in the literature, right? So integrating observations at different sampling frequencies, continuous time with discrete time is something that we have been doing for a while in financial econometrics. I think probably the first paper is by Merton in 1980s, right? Merton uses daily returns to estimate monthly volatility. French, Schwartz, and Staumbaum do exactly the same in 87. And then I think probably with the Midas paper by Henrique Giselle, Pedro Santa Clara, and Ross Valkanov in Jeffy, it's start this huge literature about realized approach. And also, it's not the first paper doing non-parametric alphas and betas. Lubelin and Nagel in GFE 2006, they essentially proposed to use rolling windows to estimate these alphas and betas. It's a very crude approach to go, if you want to take local averages, right? Ang and Christensen do a little bit better in 2012. They essentially use kernels to justify those rolling regressions, and they get a better, like a more appropriate asymptotic theory for that. But these are, descriptive methods, in the sense that it does not allow us to examine which are the main drivers of the pricing errors or to make predictions about the alphas. So that's essentially what we want to get into. Okay, so let me give you a very quick roadmap for this paper. And I'm going to start in the continuous time as promised. I told you that stock prices move in continuous time, but I have to go to discrete time because data is going to be in discrete time. And we are going to have exact discretization. It's a fully coherent model, and that's something very important for us. Then I'm going to show you how to back out the conditional alphas, how to estimate them. Very quickly, I go through the asymptotic theory. I know it's a finance session, not an econometric theory session. So I'm going to show you 2 slides probably and tell you to trust me. And then I'm going to spend some time in talking a little bit about misprices in the US market and how we try to trade, what happens if we try to trade the pricing errors we unveil. And finally, I'm going to offer some concluding remarks. Okay, so let me start at a continuous time. The estimation procedure, the realized approach for the realized betas depend on high frequency data. So, and also obviously the asymptotic theory depends on in-field asymptotics. That means that the sampling interval is shrinking to 0. So we are approaching continuous time, a continuous record of prices. So we have to think very carefully about the underlying continuous time process governing asset prices. So the main issue here that we have to deal with is that if you just write a continuous time KPM, this is not going to give you, this is not going to lead you to a discrete time KPM. Actually, it leads you to a multi-factor model, Longstaff has shown that in the 80s, right? In the end of the 80s. So essentially what we have to do is I'm back. Sorry.
Yeah, you're back. You're good
Okay.
for a couple of seconds.
Okay, good. So as I said, exact discretization of a continuous time CAPM does not lead you to a discrete time CAPM. So we have to be careful about that. So we're going to write a model for all stock prices, and from that we derive a discrete time CAPM formulation. And the other thing is that synthetic theory, that we use for this realized approach to estimate the conditional betas depends on the fact that asset prices have to be semi-martingale process in continuous time. So we have to show that in our setup that assumption holds, right? So this is a starting point. As I said, I could put a jump, but just to simplify, I'm going to have only diffusion process here. So I say that the price of an asset I, so this is log prices. So the log price changes, depends on the draft that obviously I cannot estimate, non-parametrically, plus some diffusions. So one of them is like, this is a common factor I have. So the F here goes for the common factor, right? And then you have also I can have a multi-factor model here. Obviously I'm going to later to reduce that to a single factor in the CAPM, but I could use a multi-factor model as well. And then I have in the Socratic term, okay? And for the factors, I have another diffusion. Essentially, that's how we set up the model. And you see that this is exactly the same Brownian, is the Brownian for the factors. So both the drifts here, they are going to depend on the state variables, the CT, right? And the same thing goes also for the stochastic covariance matrix here. So, or if you want the factor loadings, the sigma IT, they also depend on CT. The same thing goes for this covariance matrix between the factors. So it also depends on CT. And I have that the indisocratic term is indeed indisocratic by imposing orthogonality with the Brownian of the factors. Okay, so that's the setup. And this CT evolves in discrete time, not in continuous time. So the first thing we show is that, even if the CT, goes in, evolves in discrete time, I still get log prices that are conditional semi-martingale. So this is paramount because all my syntactic theory is going to be based on that. Okay. Then I do exact discretization of this model, and I end up with a discrete time multi-factor model, where this little f here is essentially
Marcelo?
Yes?
Just a clarifying question.
Sure.
So when you're thinking of your conditional factors here, what time horizon do you have in mind? Because those usually would match the underlying sampling frequency, right?
Yeah, now actually the sampling frequency here is going to be intradaily, but the C's, right, the state variables, they evolve in daily time in the empirical application.
Okay.
For the theory, you just need to be in discrete time, right? So, and that's essentially the frequency I'm going to work on. I'm going to work in the end to establish the conditional alphas, right? But for the realized betas, I will have a much higher sampling frequency. Okay.
Awesome. Thanks.
So the factor here is essentially integrating over the day these little movements of the factors in continuous time, right? So if you want over the day from t to t+1, and where this delta t is essentially the sampling interval that I'm going to work with later on to estimate the conditional alphas. So I have this exact discretization, which gives me what we need. So if you have only one factor here, the little f being the excess return on market portfolio, then essentially you get a discrete time CAPM. I can also tell you who is alpha and who is beta on this model, right? But it depends on all these unknown parameters that I would have to estimate, and I don't want just to come up with a parametric specification for them, right? So for at the moment, That's the only thing I need. Okay. So then I can estimate the conditional betas. You know, that's pretty simple. We have like 25 years of realized measures literature to build upon. And that's what we do. We take, you know, intraday observations of these factors and of these prices. And we look at how the covariance, this is essentially looking at the covariance, and this is looking at the variance of the factors, just as we do in a regression beta, right? You know, it's covariance divided by variance. But the trick is here, and that's very tricky because the whole literature is completely silent about that, is that it's extremely important that the CT is evolving daily, and we're estimating these guys at the daily level. So, or this could be weekly, and then we would be estimating the weekly level, because these betas are going, you know, the beta I here is constant over the day and only changes in the other day, right? So the state variable is changing only at the daily frequency, and hence the betas are changing over the daily frequency. Why is that important? Because this guy here is essentially estimating the integral, right, of this covariance, how this covariance is changing over the day. This guy here is doing the integral of this variance. So it's, or the covariance, right? Covariance matrix. So you have the ratio between two integrals, the integrated covariance divided by the integrated variance. Whereas what you actually want is the integrated ratio, not the ratio of the integrals, right? So this is only going to coincide if the CT is evolving in discrete time. Okay, so this is especially important. Now, once I estimate beta, I can estimate the risk-adjusted return. So Z hat is going to be the return that I observe for the asset minus the adjustment coming from how much is exposed to the risk F, right? And once I do that, I can replace that by alpha, the true alpha, plus the true innovation, plus the estimation error that I'm doing. We expect that if the number of intraday observations M go to infinity, this is essentially going to go to 0, right? So if I take the expectation here, the conditional expectation, this guy is going to drop because obviously epsilon IT is has mean 0. This guy is going to drop because this is unbiased estimator as well. So if you take the conditional expectation here, you get only this guy that is what we want to estimate. Okay, so that's the idea. It's a very simple idea, but it takes a little bit of time to get into that, you know, in the asymptotic theory of how to do these things. So let me estimate the conditional alphas. I came back to the same equation as I had before. That's the true Z, the true risk-adjusted return. So it doesn't have the sampling error here, only the alpha plus the epsilon. And we know that if you take the conditional expectation with respect to CT, to the state variables, you should get the alphas. Okay. So obviously here we have some specification issues that they are not really easy to deal with. First is, if you want to do it parametrically, you're going to say that, you know, these guys are alpha is affine on CT, right? So it's going to be some linear combination of the state variables. That's very easy to estimate, but you have a high misspecification risk if you do that. Or you can do a non-parametric approach, which, you know, it's more flexible and robust, because even if you had a parametric specification, you would end up in that parametric specification. You could properly estimate that parametric specification. But on the other hand, it has a curse of dimensionality, right? And obviously the measurement error that you're going to do when you estimate this alpha is going to be non-trivial, because whenever you commit a mistake in one estimate, in one particular estimate, one particular risk-adjusted return, this is going to carry through all the other estimates. So it's a little bit trickier to deal with this measurement error. So I'm going to show very quickly how we deal with the non-parametric estimates, because my time is running out. It's just a non-parametric regression using kernels. To deal with the curse of dimensionality, we essentially take principal components of the state variables. We lose a little bit of interpretation, but, you know, in terms of what are the main drivers. But on the other hand, you know, for the training strategy, it makes hell of a sense to reduce dimensionality. And as for the measurement error, we show what kind of, how the intraday, the number of intraday observations have to diverge to grow to infinity with respect to this t, the number of daily observations. So as long as this m converges to infinity at a certain rate, faster than this t, then the estimation of the realized beta is not going to affect the estimation of the alpha. Okay. So the static theory, I don't have time to talk about that, but we have all sorts of asymptotic results, so we understand very well. We have used data from US from 2001 to 2017 as instruments, as state variables. We use change in VIX, Fed fund rates, variance risk premium, Fama-French factors, the 5 Fama-French factors, momentum, reversals, credit, term spread, everything it could get at the daily level. Okay. So we have all sorts of graphs on how the realized betas look like, and then we estimate the alphas. They look like this. They look like returns that they should. And whenever you have times of big volatilities, you have times of pricing errors, which makes sense because these are exactly the times where you have limits to arbitrage as well. The alphas are much less persistent than the betas. The betas are a little bit more persistent. What you have here for alpha, linear alphas are very persistent, affine alphas. Non-parametric alphas are not persistent at all because obviously the kernel regression is going to kill most of the persistence. Then we try to put together a long short strategy which buys big alphas and short negative alphas. You see if you do affine, you get an average return pretty big if you go up to 2 days, right? If you increase the horizon, of your portfolio, it starts deteriorating the performance very quickly, whereas the volatility is more or less the same. Whereas if you look at non-parametric alphas, they are more robust, and these strategies hold for more days and do pretty well. So if you want to look at the usual factors and try to look at the alpha of those of this multi-factor model to see how these trading strategies perform, essentially you can see that the t-stats are pretty high, and they work reasonably well. We have done all sorts of robustness checks. I don't have time to speak about them, so perhaps in Q&A I can satisfy any curiosity. So let me conclude by saying that this is a novel approach to estimate pricing errors. So the papers focus on pricing errors instead of testing asset price models. It integrates high and low frequency data. It's flexible and robust due to non-parametric character, and it comes up with it ends up giving us some predictable alpha, which allows for portability. Asymptotic theory is non-trivial. We have to deal with curse of dimensionality, non-trivial measurement error. Trimming is paramount. I didn't speak about that, but it's very important to get good results using non-parametric estimates with affine samples. And empirically, it seems that betting on conditional alpha pays off, despite the fact that if you bet against unconditional alpha, looks better. So I will keep it here. Thanks, Pedro.
All right, Marcelo, thank you so much for another great presentation. We have about 2 minutes for questions from the audience. So if you have a question, you can just go ahead and unmute yourself, or you can type it in the chat. And then I'll just read it for everybody. Okay, let me ask a quick question then, and maybe give some more time for people to think. So I might have missed it, but I think you guys are using probably MTech files, right, for the time horizon. So that would be millisecond returns. Is that right?
Yeah, we get data timestamped by microseconds, I think. Milliseconds in the beginning, microseconds in the end of the data set.
Right. Mm-hmm.
So
So
react.
that's exactly my question. So I was wondering, seems like, from especially that like integrated vol literature, that when you get down to the like microsecond or millisecond, especially here if you're thinking of things like order imbalance and other just things we know that are important for microstructural pricing. How does having this different sampling periods or frequencies rather might change? I know in the end is non-parametrically, so that should accommodate sort of changes in the underlying structure, right? But I think like what sort of these CCR guys basically bridging like traditional asset pricing, daily, monthly stuff to sort of a more microstructural based approach of returns. Maybe like coming from a little bit more of the microstructural side to things that we already know to matter in the microsecond or millisecond could be useful.
Yeah, so the first thing we do is to have this refresh time. So the refresh time is essentially because here we have to deal with bivariate stuff, right? So you have for each asset, you have to compare that to the market portfolio, which we use the SPIDER ETF. So essentially, obviously they trade at different times. So there's some asynchronicity that we have to deal with. And to do that, we use refresh time. So we mark only the times at which both of them have already changed, right? And then we do we put them into regular time frames. And to deal with the microstructure error is just a noise, right? And the obvious way to deal with noise is essentially to take averages, right? So the multivariate realized kernel, that's what it's essentially doing. It's taking averages and trying to cope with all the transient persistence that you get. So all kinds of autocorrelation that you can get from market microstructure noise. So that's actually why we use multivariate realized kernel estimators. So it deals with this it uses the whole data set, right? In the sense that you use all the timestamps once you deal with the refresh time. And then for different sampling intervals, you can estimate the integrated volatility covariance. And then you can start, for instance, at 9 o'clock. Then you start at 9 o'clock in 15 seconds, and you're going to get a different series. And then you do that several times, and you get a multi-scale estimator. And this would deal with the microstructure market noise. So the microstructure noise, if the microstructure noise were IID. So if you want to get rid of microstructure noise, which is not IID, which has some correlation, which would happen, for instance, inventory control, or what else could give you, apart from asymmetric information, which will give you a persistent character to this autocorrelation. Almost everything I can think of in price discreteness or inventory control would give you very transient patterns of lead and lag. So to deal with them, essentially what we use is this multivariate realized kernel approach, which essentially is like if you want, it's like a hack estimation, right? That there's cadicity and autocorrelation estimation of the vines using different prices from these guys. And this deal beautifully with the market microstructure noise. The only problem is that it doesn't deal with jumps. So we have actually Asgas just sent an email a couple of hours ago saying that he just had the results now dealing with jumps as well, because we weren't doing that. So, but market microstructure noise, it should be okay. That's something that obviously depends on what kind of market microstructure noise. We can talk about that later, because it's a long discussion on how to identify market microstructure noise, because there are two ways of thinking about market microstructure noise: the noise that affects pricing, and the noise that is orthogonal to pricing. The one that we are getting rid of is exactly the one that is orthogonal to price. But liquidity issues, for instance, that would affect price, that we can't really deal with using things like multi-scale. So that's why the realized kernel comes handy, because it would deal also with these kind of things. Okay.
Okay, awesome. So Bruno sent a question in the chat, so you might just want to answer him in the chat because we're a little bit over.
Sure. I will do that in the chat.
Yeah, perfect.
Let me give the floor to you now.
Yeah, and then if anything, we can talk about all papers in the end if we have enough time. Okay. All right. Can everybody see my slides okay?
Yes, perfect.
Okay, awesome. All right, so thank you everybody for having me here. And this is a paper about transition to electronic trading, though I guess the angle I'm emphasizing more is automation itself. And rather than focusing on microstructure, which is usually what we know about migration to electronic trading, drop in liquidity costs and stuff like that, I'm focusing on the financial industry more broadly. So from the early 1800s until early 2000s, stock trading in the US functioned pretty much the same way. For brokers met at exchange floors like this one to buy and sell securities for their own firms or on behalf of clients. So this right here is a picture of the New York Stock Exchange trading floor in '86, during what was pretty much a typical trading session on the financial market. So if you were to just walk into any exchange floor prior to 2005 or so, it will look pretty much like this. Well, people wouldn't be staring at a camera, but it would be packed with people. So essentially, traders sitting at broker-dealer firms, so those are any kind of firms that still exist nowadays or slightly variations of them, would basically send orders to these guys here, who would in turn execute trades at the exchange floor. The way stock markets work changed dramatically around 15 years ago when trading started to migrate to electronic platforms that are similar to live online auctions. So this is a picture of the same trading floor at New York Stock Exchange taken in 2007. And as you can see, besides the nicer screens and sort of the upgraded version of the displays here, basically all the people who were physically trading at the exchange are gone, right? This is illustrative of a decrease in the degree of human intermediation in stock trading that is about a third today of what it used to be in the early 2000s. This broader employment patterns are showing this picture. So that's not just anecdotally from floor brokers, but it represents a much broader trend in stock trading and any other products more generally. So here I'm plotting all individuals in the US who are licensed to trade stocks professionally, who are employed at a registered broker-dealer. So those are people employed at investment banks, broker-dealers, traditional broker-dealers, retail, institutional, hedge funds, and so on. So those are people that were both doing trading for their own accounts, for their firm's accounts, or trading as a principal. Since 2007, as you can see, there is a very steep decrease in trader employment, which now corresponds to about a 40% or so of what it used to be. And of course, this coincides with the financial crisis. But the interesting thing here is that if you look at a wide array of other financial jobs, this drop in employment is pretty unique to stock trading. So if you think of other finance jobs or even people trading other products like commodities, you didn't experience that drop in employment. So whatever is happening is sort of idiosyncratic to stock trading in the US. So the point I'm making this paper is that the structural change that is driving this decreasing stockbroker employment is basically trading automation. So what you can see here is the IT capital stock investment at the brokerage firm. So this is the investment level in things like data frames, mainframes, computers, fiber optics, and so on at the firms that employ the stock traders. So you can see that from 2005 to 2010, there is a massive investment in technology upgrading, which is sort of the real side effect of this transition in stock trading from floor broker or physical based trading into electronic markets. So in this paper, I answered the question, how the automation of trading impact firms and workers. So today I'll just show some results for workers. I'm still finishing this stuff with firms, and probably they wouldn't be able to fit anyways. And what I use in this paper, since dealing with transition to electronic trading is sort of elusive, is a policy that was passed by the SEC, which is called the Regulation National Market System, that initially intended to foster competition between exchanges and lower trading costs to sort of help small investors and unsophisticated investors to gain access to stock trading. But that ended up as sort of having as an unintended consequence fostering speed-driven competition, which then led to trading automation. So I use the universe of US broker-dealer firms and workers. This is new data that I put together. And then I find large negative employment effects. So one way I interpret these results is that for every computer per worker, which is my IT measure here, so you can think of every additional computer or screen or computer screen per trader, 100 trading jobs on average between 2007 and 2009, which is the post-policy period, were destroyed. So in large financial centers like in Manhattan, you can this amounts to about 400 jobs. And then if I don't have time to get into by the end, which probably I won't, this is sort of illustrative. This is kind of going back to that figure I showed with the other financial jobs. These large drops in employment are only experienced by stockbrokers. So if you look at sort of placebo type traders or other financial jobs, you don't see the same drops in employment. And these results are also robust to several other potential demand side factors that, rather than sort of having this capital labor substitution from the farm side story, you could think of just like an actual drop in the demand for brokerage services, so you don't need as many traders as you needed before. And other shocks during the Great Recession, the results I find are robust to taking those into account. I also find a higher, a skill complementarity. So brokers that have higher skill, measured as just having more advanced education degrees, their wages increase relative to those traders that are less qualified. But those are still sort of preliminary, so I don't put too much weight on it. So I make three main contributions to the literature. The first one is that even though, like I said, we know quite a bit about what electronic trading did in terms of market structure, so the sort of most traditional story is that liquidity costs decreased when markets shifted from open outcry or floor trading to electronic trading, because there's just less informational asymmetry and stuff like this. But in reality, we still don't really know how the financial industry more generally has changed because of this massive shift to automation. So simple questions as who are the winners and losers from trading automation are basically unanswered. And this has been sort of a big, there's a larger backdrop, especially in the sort of popular perception and in the financial press, that this rise of automated trading, which is of course exemplified by high frequency trading, has essentially rigged stock markets. So if you're familiar with Michael Lewis's Flash Boys book, that's basically the story in the book there, where the sort of robots and super high tech firms are sort of screwing the average American pension fund dollars. So there is a sort of ambiguous of welfare effects, and if we want to be able to get into who's actually winning and losing from this, we need to have a sort of a broader framework to think about firms and think about workers, and not only microstructure. So the second contribution I make is to assemble this data set, which is essentially a linked employer-employee panel with all equities brokers and traders and broker dealer firms in the US, which essentially we don't really know much about them. So since there's like all this data opacity, even though the data is available because of regulation, it just hadn't been put together still. And then last, there's a point in this paper which speaks to the role of financial regulation in shaping market access and behavior. So like I said, the idea here was to kind of have this regulation that is going to help the small guy, because it's going to make trading cheaper, it's going to decrease liquidity costs, it's going to make markets exposure to stock markets easier for people that don't have as much resources as more traditional investors. But that had as an intended consequence exactly, potentially, even though I don't have those welfare effects, still hurting the small guy, since it created a landscape, a competitive landscape that rewarded firms and those with resources to heavily invest in technology, rather than just a person with a more traditional sort of low-tech broker-dealer, or even trading using the cell phone or something like this. So let me give you a little bit more background on the policy. This was a regulation that was passed in 2005. It was fully implemented in 2007. So this is only this only focused on stock markets. So other markets like bonds or commodities were not affected by it. And the SEC's idea was basically to create a national market system, which is the policy's name, which is the NBBO, if you're familiar with it, which is sort of a price aggregator, right? So you would have this online book that would combine information across all different exchanges and everything that was being traded at these different exchanges. So rather than, if you can think of this as like when you go to sort of a book a flight, and then you would go to each airline's own website and try to find out which one has the cheapest flight and stuff like this. And now we have Google Flights, where you can just go to one marketplace and compare all different flights, the different airlines options offering you the flight you want to take. So this obviously increases transparency. So the idea was that this was going to make trading cheaper and more and easier. And within this national market system, or the NBBO, several provisions would apply, and one of those, which was probably the most contentious one, was Rule 611, which is a price protection mechanism. So the idea here is that always the cheapest stock would need to be the one traded. So that's sort of the top of the book story, where if you ask your broker to buy IBM stocks, it doesn't matter whether your broker would like to buy from at NASDAQ or AMEX or something like this, they would need to trade at the exchange that is offering at the cheapest price. So you can choose whether you want to do Go or Latin. You would always have to buy the cheapest flight, even if your broker had an incentive to afford to go with different airlines for some reason. So this was, of course, meant to protect the clients who, there's this agency problem that maybe brokers weren't trading on the behalf of the client's best interests. But what this did was to create the ability for fast firms to essentially do something called a latency arbitrage. So because now there's predictability in the order flow, I know where orders are going to be routed, which is at the top of the book. If I'm fast enough, I can front run those orders, and then I can, sort of flick the quotes at the top of the book and make money by simply being faster. So this dramatically raised the incentives, the actual monetary rewards for you to being fast, and the whole environment is actually online. So the New York Stock Exchange, for example, introduced the hybrid market around this time, exactly to be included in this market redesign promoted by the SEC. So I'll just go quickly over the data. So trading stocks in the US is regulated like in Brazil. So you need a license and pass examinations. So the way the data sort of works here is that there's this website where you can go and check online your stockbroker or the firm you're broken with, right? So this is how the website, which is called brokercheck.com, looks like. And essentially what I do is to script the whole website, which has the central depository registry sort of underlying it. So this includes not only active traders and firms, but also the defunct ones. So if I go back as far as I can and into the 1970s, I have everybody who has ever traded professionally in the US and every broker-dealer that has ever existed in the US as well. So let me be very specific as to who is in the sample. So this includes everybody who has a license to trade anything in equities. So if someone is trading commodities but also has a license to trade stocks, this person is in the data. So what I do is I retain only the people that have a Series 7, which is the most basic examination you have to pass in order to trade stocks in the US. And because the way these records work, even if you are trading a different product and you actually had the Series 7, your license is not going to be active the same way. So I can know basically, because of the way these licenses define very narrow tasks, I know pretty well, combining your licenses and the broker-dealer you're working at, what kind of stuff you're trading, to the extent that whether you're trading stocks or not. I don't know the products, of course, that you're trading, but I know whether you're doing, commodities or whether you're doing stocks. And this is important because, like I said, people that trade exclusively non-stocks shouldn't be affected by this policy. And that's actually something that I use as placebo tests in the paper. Let me skip this. So this is just plotting the county level employment of stockbrokers in the US. So this is data for 2000. The counties that have missing data is because there are registered broker dealers there. This is the same employment level, but in 2018. And as you can see, a lot of those jobs are gone, which is just spatially a spatial representation of that time series I showed you in the beginning. So let me get into the empirics and then move on to the results. So this regulation, of course, was meant to affect all stocks alike. So there is no treatment and control in a classical sense. So what I gotta do is to assign treatment somehow, right? So I use something that's pretty standard in the literature, which is just have a continuous treatment where certain firms and certain workers are going to be more or less exposed depending on some intensity measure that I'm going to define in a second. So what I use is this local variation, and by local you can think at the county level, in the degree of IT tech availability that a certain area had prior to the policy. So the intuition behind this is, if I'm a firm in an area that already has a lot of infrastructure, and then you can think as a sort of the most basic thing is like fiber optics, right? So if you want to do electronic trading, you need stable and high-speed internet minimally. So if you don't have internet, you can't do electronic trading. You can't automate, right? There's nothing you can do. So rather than using take-up, which is of course endogenous to the firm, I just use the availability as sort of an intent to treat model, and I will be comparing firms in counties that offered a greater exposure to automation to firms in counties that offered a smaller exposure to automation, depending on how much pre-existing infrastructure in tech each county had. So my measure is the number of PCs per worker at trading firms, at financial firms in that area. I need good cross-sectional variation in this exposure if I want to identify anything. So you can see that varies a lot across the US. Let me skip this. So then what I do is a standard diff and diff, where rather than have a treatment and control group, I will have just a continuous treatment intensity, which is going to be exactly this number of pieces per worker in each area. The identifying assumption is the standard one in this context, which is that without the regulation or without the policy, the training and the outcome would have remained the same once you're sorting across the different intensities, which is sort of going back to the idea of treatment and control groups. These are the baseline results. So for columns 1 to 3, this is firm level employment. So we'll aggregate everybody who's employed at each firm. And then as you can see that after the policy, firms that were in more high-tech areas, i.e. that were more exposed to automation, experienced larger drops in employment than firms that were in less exposed areas. And columns 4 and 5 basically do the same, but using individual level employment. So there's a worker dummy for whether that person was employed or not in that year. This is just a visual representation of trends. Let me skip that. So this is like sort of a event study. So you would want this to be 0 essentially before the policy, which is the case. And then you would want to see those negative effects kicking in after the policy is implemented. There's a reason why I stopped in 2010. I don't go beyond that, because there were a lot of regulations targeting trading automation in 2010, and to try to deal with the fallout of the financial crisis. So I don't want to kind of have this confoundness from sort of new regulations affecting stock tradings after 2010. So this is just a formal way to look at those pre-trends, a more formal way, not just visual. Everything looks good. There's a couple of sort of standard and robustness tests as well. And then let me just conclude pretty quickly by saying broadly what I addressed in the end. So the idea here is that, okay, so since you have this firm side story, of course, that doesn't rule out, especially demand side stories, which essentially kind of boils down to there is less demand for brokerage services, or there's something else going on during the financial crisis that might be sort of driving the results, at least part of the results in the short term, right? So like I said, I use this plausibly unaffected workers as a sort of placebo group. So these are workers that I don't expect to be affected by the regulation I use, but I expect to be affected by the financial crisis in a similar way as stock traders. So I don't see any effects for those. You might be worried about big investment banks, especially Lehman Brothers, of course, that suffered a lot during the crisis. If I drop brokers employed at those, it doesn't change. If I drop one by one large financial centers, also there's no changes. And then kind of imperfect ways to control for the housing bust also don't seem to change anything. And then essentially this is plotting that, but just with each regression individual. And then lastly, what I do is there is also during the sort of the same period, or like in a broader period, there is an increase in the number of online brokerage services. So this is basically mobile, like cell phone trading type of stuff. So you don't need that intermediation anymore. You can just trade yourself. You don't need a broker dealer. So that might represent a downward shift in the demand for brokerage services. And if I control for the local use of online brokerage services, so this sort of control for the demand, the local demand for brokerage services, the results also don't change. So to conclude, I find large negative effects on broker-dealer employment that was caused by trading automation. Then again, this is just the intent to treat, is not the actual treatment, because that would be endogenous. Those effects are economically large, so about 100 jobs per additional machine, if you will. And the next steps I'm doing, which is working now, is basically look at stuff like leverage, profit, portfolios, and stuff like this at the firm level. Thank you so much. So since I am, okay, so there's nothing in the chat. So I think we have 1.5 minutes or 2 minutes for questions. So same as before, you can if you have questions, you can unmute yourself and ask, or you can write in the chat. And then I also want to invite people who might have had questions for the other two papers to ask those now.
So Pedro, let me ask a question, a very quick one. Obviously, there is a huge trade-off here, right? You have like traders, you know, let me put it like old guard traders, you know, like being fired. On the other hand, you have the rise of the HFT with all people being hired by them, you know, computer scientists and whatever, right? So do you have an analysis of welfare gains or welfare losses on that, or is just a particular analysis of how a specific group of people were affected?
So yeah, awesome question. So that's exactly where I want to take this next. In order to do that, I think convincingly, I need the firm side, because I need to know what kinds of firms were left and who basically those firms cater to, right? So if those are extremely high tech hedge funds, or that kind of have like those kind of top level institutional investors, and the very small brokerage firms that cater to basically unsophisticated investors are the ones that got wiped out. That's kind of where you start to talk about welfare, right? You can think, of course, of like gains and losses in terms of the worker, but at the end of the day, the way I look at this is from the perspective of the demand, right? It's the people who are trading, either using intermediates or trading themselves, that you can see that. In terms of employment, that's a super interesting point, which is, of course, you got rid of all this sort of unsophisticated traders, but now you have quants, right? You're hiring all these computer science people, people with PhDs in physics and so on. So I think the expensive sort of the margins here, the story is like, of course, this is a labor saving technology, so you're not going to be hiring as many CS people as you had physical traders before, but you still have some positive gains in employment in those sides. That's actually kind of a loophole in the legislation in the US right now, because those folks that are not physically trading, even if they're designing algorithms, they are basically nowhere. They don't need any kind of license. It changed up a little bit more recently, but basically they don't need the same kind of licenses and examinations that actual traders do. So it's kind of unclear how many of those exist. I'm trying to do that a kind of a separate piece of the paper, but definitely there's some people who are not quote unquote classical traders that are working as traders or part of the trading supply chain, if you will, that are part of it right now, but weren't part before. And those are exactly those type of like super high skill people you would expect.
Cheers. There are also like the brokerage firms have changed a lot. So if you look at the Robinhood and Warren, like the work they have been doing, not only in the US, but also how they spilled over to other countries, or at least their framework. Do you have a view on how they work? I have no idea, right? So it's just pure curiosity. So are they also very sophisticated, the kind of people they are employing, and how does employment profile looks like?
So that's another great question. So in general, I think there's a slight misconception as to what a trader used to be. So when trader was physical, and you can think of floor trading, basically those folks at the beginning of the picture. The skill those guys had to do was like they had to be very good at fast, simple math, like sort of mental calculations, and they had to be physically strong. So they had to push people around, they had to beat people at the peak, they had to literally be able to have the kind of a stamina because that was a very valuable skill in the marketplace when you were a trader. So if you had a PhD in physics, that would basically be of no use for you whatsoever. So you had a bunch of like bouncers, like club bouncers, hairdressers, all kinds of sort of non-finance occupations, people who had non-finance jobs that would become, traders because they were very good at math, kind of simple math, and they had sort of the physique to do that. So the way that the skills in the marketplace change now, you need programming, you need to, have some kind of quantitative background, right? That's true for basically all countries. So you can think of whether the country is more like on the frontier or less on the frontier for that. So for instance, proprietary trading is not a big thing in Brazil still. And you can't really say there is high frequency trading in Brazil, even if some people say there isn't. There's, it's just a complete different like technological landscape, both from the firm side, and the exchanges also don't offer enough infrastructure for you to be as fast as you could. But I think eventually we will get there, and you should definitely think that the skill premium, also from other work we know from Thomas Philippon, is increasingly larger in finance. So the more high skilled you are, especially in trading, basically the higher wages you can make relative to a less skilled trader. Okay, so I guess for everybody else, if we're kind of 5 minutes over, so we should probably end here. So if Marcelo or someone else wants to stay on, I don't know exactly if we can stay on for 5 minutes or so, or if this is gonna just close. Yeah, go ahead.
That's it?
Yeah, from our end, yes.
Humberto, Marcelo.
Tô aqui.
That's
All great.
Okay. That's okay? Thank you.
Yep. Thank you very much. Obrigado aí.
Obrigado, Marcelo, Humberto, prazer, viu?
Valeu, galera.
Tchau, parabéns.
Obrigado.
Tchau.